When you think about digital assets, what's the first thing that comes to mind? For most people, it's the price. The daily ups and downs, the charts, it captures all the headlines. But behind the scenes, there's a completely different conversation happening. Today, we're going to pull back the curtain on that conversation. We're not looking at speculation, we're focusing on how long-term institutions analyze the fundamental evolution of these emerging tech systems.
And this quote, this really just nails it, doesn't it? While the public conversation gets swept up in volatility and short-term gains, the institutional analysis is a search for something completely different. Durable, long-term infrastructure. They are, quite simply, playing a different game with an entirely different set of rules.
So let's be perfectly clear right up front. This isn't about picking the next hot thing or predicting profits. It's about understanding the mental model, the rigorous framework that's used to tell the difference between fleeting hype and a truly foundational technological shift. Okay, let's dive in.
To really get the institutional perspective, we first have to kind of reframe what this technology even is. We have to stop thinking of it as just a single asset. Instead, think of it like the construction of a new digital infrastructure, one that's being built in distinct layers, one on top of the other, over time.
And it all starts right here. The core innovation of Bitcoin wasn't just a new kind of money. It was the technological breakthrough of digital scarcity. Think about that for a second. For the very first time in history, we had a digital item that could not be copied or counterfeited without a central party. That was the bedrock for everything that came after.
And this foundation, this idea of digital scarcity, allows for a whole new technology stack to be built. It's a lot like how the early internet grew beyond just sending simple emails. First, you have that foundational layer. On top of that, an infrastructure layer can be built for things like payments, settlement, and identity. And that layer, in turn, supports a whole new application layer for businesses and even governments. See how each layer builds upon the last? So, if you've got this whole stack being built, the multi-billion-dollar question becomes, how do you separate the real, meaningful signal from all the noise? Well, that brings us to the core of this whole explainer, the institutional evaluation framework.
So instead of watching price charts, serious analysts are asking a series of tough questions. First, does it solve a real-world problem, or is it just a cool solution looking for a problem to solve? Second, and this is a big one, are talented developers actually building on it? Because capital always follows talent. Third, are the economics sustainable? I mean, is there a clear model for how the system supports itself in the long run without relying on constant hype? Fourth, can it actually work with regulators, or is it designed to be fundamentally against them? And finally, are serious organizations, like big companies or governments, actually starting to use it? A project has to have good answers to these questions to even be considered potential infrastructure.
Now, this framework, it's not some kind of secret formula they cooked up out of nowhere. It's actually based on patterns that we've seen play out in every major tech wave over the last 50 years. History gives us a really valuable map for what to expect, and, maybe more importantly, what to ignore.
Just think about the early days of cloud computing, or even the internet. There's always that initial breakthrough. That's followed by this chaotic, wild era of experimentation, where thousands of projects get launched. But then, inevitably, comes the consolidation, the shakeout, where most of those projects fail. That leaves only a handful to mature into the essential, almost invisible utilities that we all rely on today. It's a predictable, repeatable cycle.
And this comparison just makes it so clear. On one side, you have the signals of hype, all the stuff that grabs headlines, right? The focus is on price, speculation, and there's not much real adoption. On the other side, you have the signals of longevity. These are the projects solving real problems, showing steady user growth, and they have a clear, sustainable model. The crucial point here? Institutions are searching exclusively for the signals on the right. Okay, so armed with this historical context and that evaluation framework, let's talk about how institutions actively separate those meaningful signals from what is, let's be honest, a deafening amount of noise in the market. And here's where you can really see the two worlds diverge. The speculative metrics are loud and chaotic. Price swings, social media trends, all that stuff. But the institutional indicators, they're quiet. They're almost hidden. We're talking about shifts in developer activity, steady growth in actual network usage, and progress toward regulatory clarity. These are just indicators of the system's health, not instructions to buy or sell.
Now, here's a point about regulation that might sound a little counterintuitive at first. For these long-term players, regulation isn't really seen as an obstacle. It's seen as a necessary filter. It raises the bar, it weeds out the weaker projects, and it provides the clear rules of the road. And that clarity is an absolute prerequisite before billions of dollars can be invested into building durable, long-term systems.
So, after all that chaos and experimentation, what does a winning technology actually end up looking like? Well, funny enough, it often becomes boring. Its growth is slow and steady, not explosive. It becomes quietly, genuinely useful, integrated into the background of other systems we use every day. And fundamentally, it's built to be compliant. Just think about the protocols that run the internet, like TCP/IP. They're essential, they're incredibly powerful, and they are utterly boring to most people. That's the end goal.
So let's bring this all together. The goal here today was not to give you a crystal ball to pick winners. It was about giving you a new lens, a framework for understanding the slow, methodical, and disciplined process through which real, lasting financial infrastructure actually gets built. It's a way to analyze any emerging technology, not for its price today, but for its potential utility tomorrow.
And that really leaves us with one final big question to think about. Once a technology makes that successful leap from a speculative asset into invisible, essential infrastructure that we all just rely on, well, its value can no longer be captured by a daily price tag. So the question is, how do we even begin to measure the true value of something that has become a fundamental and largely unseen part of our world?